Hi everyone, welcome to tonight's webinar. Tonight we're going to be talking about earnings reports. Earnings reports I probably get more questions about trading and analyzing earning reports maybe than any other topic. So this subject's kind of long overdue. We trade earnings winners and earnings losers all the time within our trading room. And trading these and these reactions to the earnings reports can pay off in a huge way. I absolutely love trading earnings winners and earnings losers. And we're going to talk a little bit more about how we analyze them, how we prepare to trade them and things like that. So before we go ahead and get into some of that information, just want to remind everyone that we are having a retreat in Florida. The hotel extended the discounted pricing for us. So we have a little bit more room for everyone to join us at these discounted rates, which we're super happy about. And so that's awesome. Hope everyone can join us. It's going to be great. We already have a good group of people coming, but we want you to join us. It's going to be awesome. If you have any questions, let me know. Lastly, just real quick, I want to talk about this. This is calftax.com. We've launched a tax firm, and we have run our quotes against other tax firms time and time again. We've tested so many different firms, and the truth is, with our back testing, we can do your taxes just as good, if not better, for a significantly discounted price. Okay, and we're doing this because we're trying to break the tax industry. We feel that's an area that is inflated and needs correction. And so that's what we're trying to do. We're trying to bring really high quality services to you for a discounted price. So head to calftax.com and get a free quote. All right, enough of that boring stuff. Let's go ahead and talk about what we really want to talk about tonight, and that is earnings. The first thing I want to talk about with earnings, I want to introduce this idea to you of relativity. Okay, the actual numbers do not matter. That might sound crazy, but it's true. Okay, when it comes to earnings, the actual numbers do not matter. It's the relative numbers that matter. And I'm going to explain what I mean by that. What I'm actually going to do with this webinar, I'm going to talk about the most important concept first, because there's nothing else that you get from this webinar except this slide alone. It will make a huge difference in the way you analyze earnings. But after this slide and after I talk about this concept, I'm going to go ahead and dig into the dirty details of everything and how we analyze them a little bit closer. But I want to bring up this example here. Okay, we have two companies, company one and company two. All right, and they've both released earnings, and here's the earnings report. Now you're looking at this EPS. I have no clue what that means. Revenues, why is that significant? Sales guidance, what does that mean? Actual estimated, what does that mean? That's why you're watching this webinar, right? So that you can learn what these mean. We'll get into the details of that. But what I just want to talk about real briefly, okay, let's take a look at company one. Their earnings, okay, were $1.50 a share. Company's two earnings were minus 3 cents a share. You might look at these companies and say, wow, company one is definitely a better company, right? Their earnings are way better than companies two's. However, that would be inaccurate because we must, like I said, pay attention to the relativity of the numbers in comparison to what the estimates were. All right, so back to company one, EPS, again, you may not know what that is yet. That's fine. We'll talk about that. The EPS was $1.50. That's huge. That's great, right? Especially compared to company two's, whose EPS was minus 3 cents. What the heck? They're losing money. What's going on there? Well, now we have to take a look at the estimated aspect of the EPS. Okay, company one was estimated to have $1.60 worth of EPS, but they came up short at $1.50. This is actually an earnings miss. This is bad news for the company. And company two, on the other hand, actually beat earnings expectations significantly. Their EPS was minus 3 cents. Well, everyone on the street, everyone in the stock market was expecting them to be minus 30 cents per share. So that's actually a huge earnings beat. So don't let the numbers throw you off. We must pay attention to how the numbers come up relative to the estimates. Okay, same thing with revenues. Same idea. Company one actually missed, in this example, actually missed the revenue estimates by $5 million. Well, company two, they only do $3 million. How in the world would their earnings be better than company one's earnings? Okay, we're not talking about financially analyzing these companies. We're just simply talking about trading the earnings reactions. And these are the types of things you want to pay attention to. Okay, same thing with sales guidance. We're going to talk about guidance, why that's important. Company two's guidance, they're only expected to do $3.5 million worth of sales, right? How is that positive compared to company one, who's going to do $108 million worth of sales? Well, the difference is company one's estimates were below, what they're estimating is below what people thought. And company two's is actually outperforming it significantly. So in this example, it seems weird. Company two's earnings would actually be significantly better relative to the estimates compared to company one. And that's all we care about. All we care about is the relativity of this action. Okay. All right. So let's go ahead and dig into a little bit here what all this means on a more deeper basis. Okay. So first of all, I want to talk about the fact that price factors in everything. Okay. We must imagine that the price of every company factors in all known information about that company. So let's go ahead and talk about Apple. Apple's a great company. They make tons of money. right? Everyone has an iPhone, everyone loves their iPhone. We know that, okay? And that positive view upon Apple is factored into its current price. So you might say, oh, you know what? I like Apple, and today I like it even more than I did yesterday. I'm going to go ahead and buy it. It doesn't really matter what you think. It matters what the street knows. What does Wall Street know about Apple already? Everything's out there and is transparent to the street, and therefore the price is accumulation of that information. Okay. Now let's talk about insider trading for a second. Okay, why is insider trading illegal? Okay, because they have information that isn't known to the public and isn't factored by the markets. That's what gives insider traders a benefit. Right? Someone might know, oh, this company, they just found the cure for cancer. Right? I'm going to put all my life savings into this company because it hasn't been released yet. Well, then as soon as that news becomes public information, the stock, increases by 10,000% or something ridiculous like that, right? It's because that cancer news isn't factored into the price yet. No one knows about that. There's no way to have an advantage. Now, perhaps you have an inkling and perhaps you speculate, hey, this company, I think, just maybe have a chance to find the cure for cancer. Well, that's where you might be able to feel you have an advantage in terms of speculating about the stock, okay? But just keep in mind that the current price of a stock factors in all known information about a stock, all right? So I'm going to talk a little bit more about this. We often hear this idea of, buy the rumor and sell the news. And so if a company releases earnings and a company, tripled in size, or if it grew 100% in revenues, over the last 2 months, that doesn't mean anything if people expected that to happen, right? I mean, sure, great for the company. They did that. Wonderful. 100% revenues, awesome. But as a buyer of their stock, it doesn't matter because if estimates and if the Wall Street, traders and analysts were expecting them to do 150% increase in revenues, but they only did 100%, that's actually bad for the company, right? And the stock's going to go down. So, you'll see on message boards all the time, some company will release earnings, oh, they increased in revenue by 10%, and the stock drops 20%. And you're thinking, what the heck? They grew from their last quarter. Why in the world is that happening? Well, it's because the estimation, right, was greater than the result. And that estimate is what factors into our price. It what leads our stock prices, to be at certain levels. Speculation, the cumulative speculation. Just imagine, the stock markets know everything. Sometimes people will talk about the invisible hand of the stock markets, that they know everything that's out there, right? Everything, the speculation, everything has a fair price. You kind of have to lean towards that. Now, we give ourselves as day traders advantages through certain chart recognition, pattern recognition, momentum trading, and things like that. And that's where our advantage comes in. But I'm just trying to really, hone in on this concept that the numbers is all relative, okay? And just because a company grew more than it did the quarter before, that doesn't mean it's a good thing for the company. If it's not what it expected to do, it's actually a bad thing. And that's why we hear so often, buy the rumor, sell the news, because if a company's expected to come out with a cancer, right, let's say the company was expected to find the cure for cancer. Well, when the company actually releases that it officially found the cure for cancer, if everyone already expected that to happen, the stock's not going to increase because that's already factored into the price. Okay, enough of that. Let's go ahead and talk a little bit more about these earnings specifically. Okay, so this is just kind of an example here. Companies will release earnings 4 times a year. Okay, 3 times those earnings will be quarterly earnings, and then once at the end of each year, they're going to release what we call an annual financial report. Okay, now you might hear about an SEC filing. What the heck is an SEC filing? This company just filed a 10Q SEC form. What does that mean? All that means is that they have filed their financial reports for that quarter. Okay, now a quarter, of course, there's 4 quarters in a year, so we get 4 reports, and the last one being an annual accumulation of the previous financial year. Okay, and this is a requirement, right? If you're a private company, you're not doing this. You're not releasing your financial information. If you're a public traded company, then you have to. It's absolutely required. If you don't, I don't even know. I mean, you're done for, right? NASDAQ's going to kick you off. There'll be some fine. I mean, it's just not going to happen. Private companies, on the other hand, do not release this types of information. All right, so expect earnings 4 times a year for each company. Now, what are earnings? To put this very simply, very simply, earnings equals a company's profits. Okay, put it very simply. Company's profits, that's all we're looking at with the earnings. How'd they do? Okay, so you're going to take all the company's revenues, subtract all the expenses, and boom, there's your earnings. Now, how do we calculate that a little bit more specifically, and how do we analyze these earnings? We have certain tools. Okay, and the first tool or measurement tool that I want to talk about these earnings is EPS. It stands for earnings per share. You're going to see this all the time when it comes to earnings. People will talk about EPS all the time. Okay, people love talking about EPS. Now, what the heck does it mean? All right, EPS. To calculate EPS, you can take your net income of your company and divide it by common shares. All right, to get a little more specific about this, let's use this example. Let's say you own a company and you did $100, in income. You have $100 of income for this last quarter. Okay, and you're a publicly traded company and you have 100 shares out there on the market. So what does that mean your EPS is? Very simply, it's $1. Okay, very simple to calculate. That is EPS. We're going to get more into the details about how that affects estimates and things in a second. Now, what's the next tool? Sales. Sales is the economic price paid by customers, okay, on all of your items. All right. So if you own a t-shirt store, you sell 10 t-shirts in 3 months, and each t-shirt you sell at $10 per shirt, your company sales would be $100. Okay. So very simple. Now, revenue, how is it different from sales? Well, truthfully, in some industries, it's actually the same. They use them interchangeably. But it's important to note that there is a difference because certain companies will actually gain revenue from non-sales income. And what I mean by that is, let's say Google wins a court case and they win $40 million in damages from the person they sued. Well, right? I mean, that would technically be revenue for the company. It's not sales, but it's revenue, right? Because it's a court case settlement, they made money. They defended themselves, whatever the case may be, they won the lawsuit. Now, revenue is frequently talked about and referred to as a company's top line, and this is because revenue actually typically will fall on one of the top couple lines of an income statement. So when you hear people talk about what's their top line, they're referring to revenue. Okay. People care a lot about revenue growth. Now, some other things people use, and I'm not going to talk specifically about these, but year-over-year growth and same-store growth for a company. Okay. Now, let's say you're selling T-shirts, and in 2017 you sold 9 T-shirts, in 2018 you sold 10 T-shirts. That's great. Your year-over-year growth is going to be, about 10% roughly. Same-store growth, same thing. Maybe you own 100 stores across the nation. People want to know, are your revenues only increasing because you're opening stores, or are they increasing because your 100 stores across the country are actually growing within revenues, or are those stores just stagnant and your numbers are only inflated because you've opened 30 more stores, right? But they're not really growing; you're just opening more stores. Okay, those are the types of things that gives us insight to. Now, the most important thing I want to talk about next is guidance. Okay, this is without question the most important part of an earnings release. Okay, and I'm going to explain why here. Guidance, the company comes out with their guidance, and it's usually at the end of an earnings call or after the previous sales, revenue, and EPS information has already come out. The company's going to come out and say, all right, there's our information for this last quarter. Here's what we're expecting for the next quarter. We're expecting to do these sales. Okay. Now, this is important because remember how we talked about, the stock price factors in all known information out there on the stock market? Well, in this case, this is one of those things that changes that, because this is what happens. There's a whole bunch of economists and bankers and things who are trying to guess what your t-shirt stores are going to do in the next quarter. And they might say your t-shirt stores we're predicting are going to sell 11 t-shirts next quarter. But if you come out and say we're expecting to sell 13 t-shirts next quarter, that's a huge push. That information was not known to the stock market before, and people freak out. They're like, whoa, that's almost 20% more than the bankers and analysts thought it would be. This is great. And your stock price will jump accordingly. Of course, not always. There's always going to be some finite, there's always exceptions, okay? But just as general rules, this is kind of the information that we want to have understood, okay? So your stock price factors in your estimates, okay? It's super important. Now, what I actually want to do real quick, I actually want to go back to this first slide real quick and talk about it again. So bear with me here for a second. Let's go back here. All right, okay, let's talk about this one again. Because now that we've actually talked about what these things mean, I want to talk about this example again. Earnings per share, we know what that means. Revenues, we know what that means. Sales guidance, we know what that means. Now, what I want to talk about here, and let me pull out my handy dandy little laser pen, little laser pointer here. Estimated and actual. This number from estimated, a company's earnings per share estimates, revenues estimates, sales estimates, etc., Those are estimates that the company they themselves put out either the prior quarter or the prior year. Okay, so these estimates, top two here, the store and the company itself put out these estimates the last time they released earnings. They said, we expect to do this the next quarter. In this case, oh, they came up short a little bit. In this case, they came up short $5 million in revenue. Okay. However, sales guidance, this estimated number does not come from the company itself. This comes from the street. And so this number will actually vary. This comes from, JP Morgan, Bank of America, Goldman Sachs. All these companies an analyst will place estimates. Okay. So this is important to mind. EPS, revenues, sales, etc. The estimated numbers that they're compared against are actually put out by the company itself, either the quarter or the year before. However, when a company releases sales guidance for the next quarter, the estimates that we're comparing that with comes from bankers and analysts and things. Okay, I hope that makes sense because that's important to know the difference there. Okay, now let me go ahead and fast forward back where we were. Feel free to pause this video and take a stop if you have any questions about any of this information. Okay. Next, what I want to talk about is analyst upgrades and downgrades. Okay, this is, in my opinion, probably the goofiest thing on Wall Street. It's so silly to me. I guess there's no better way to do it, but it's so silly to me because a stock will go from $10 to $20, and an analyst will raise their price target from $18 to $20 when it does that, after the fact that it happens, right? Or an analyst will have a price target. Okay, Netflix is going to trade at $200. Netflix is trading at $200, right? It's like, what are they doing? Right? They're just coming out and stating facts. And then Netflix goes up $30. And then when that happens, the analyst comes out and says, I'm raising my price target to $230. It's like, okay, great. We knew that, right? Anyways, it's silly. I don't want to talk too much about that, but it's just silly. But there is something that we can take away from this whole process, from this whole idea of analyst upgrades and downgrades. And when I say analysts, remember, I'm talking about just people like me and you. I mean, we're not analysts, right? But we analyze things, and these are bankers and people for Goldman Sachs. They're professionals, of course, but they're not within the company, is what I'm implying. Okay, these are not inside company people making these statements. All right, so don't worry too much about the actual number that these analysts come out with. Instead, worry about the direction and the sentiment that they take. So, for example, say the price target of let's keep using your T-shirt company. Okay, let's say your T-shirt company, the stock right now is $20 worth of stock. Well, JP Morgan just absolutely loves you, and they've had a $100 price target on your stock for the last 5 years, even though it hasn't even come close to that. It just sits there because who knows why. Well, they randomly come out after your most recent earnings for your T-shirt company. You sold 11 T-shirts, right? Which is great. And now they're going to come out and say, we're going to raise this price target to $250. And you're like, what? It's a $20 stock, and it has been for the last 5 years. And here you are, raising your price target by 150%. It's not even close to your original price target. What happened? I mean, you really will see stuff like this that is so goofy and silly, and you're going to ask yourself, what the heck is going on? Don't care about the numbers, okay? That's not our concern. The concern is the direction of the upgrade. In this case, the price target was moved upward. That's very bullish. This is a catalyst that would move the stock upwards, okay? Now, let's look at the same thing, okay? Remember, ignore the numbers, just focus on the direction. Your T-shirt company, let's say that, I don't know, Wells Fargo has a price targeted on your T-shirt company stock to be $10,000. And they come out after last earnings and they say, okay, we're going to actually lower our price target to $9,000. And you're thinking, this is so silly. This makes no sense. Who cares? Your price target is outrageous. Again, don't care about the numbers. Just focus on the direction of either the upgrade or the downgrade from the price target. Now, there's another aspect of analyst upgrades and downgrades more than just price targets, and that's the buy or sell rating. Okay, and analysts will use this little chart. They'll say, our rating on that stock is a hold. Our rating on that stock is an outperform. Our rating on that stock is an underperform, sell or buy, or even strong buy. Okay, these are all, if you take a look here, these are all words that you will see in analyst upgrades and reports. And this is what it means. Again, it doesn't matter. Okay, maybe your T-shirt company, one bank has it at an underperform, and they move it to a hold. It doesn't matter if it's an underperform or a hold, really. It just matters that it got more bullish. It made a step in the right direction, being bullish. Okay. Now, let's say another company is a strong buy and they get downgraded to outperform. Well, your T-shirt company just got upgraded to a hold. This company's move downward is bearish. Your company's move upward is bullish. And you might say, well, the company still had an outperform. My t-shirt company's only at a hold, so they're going to be doing better than me. That's not the case, because all people care about is the overall sentiment and direction. Because remember, it was factored in that that company was a strong buy, and the current price action, the current price of that stock had factored in that it was a strong buy. So when it got downgraded to an outperform, well, the market then adjusts, right? Stock traders, shareholders adjust, and they say, oh, I don't like that analyst downgrade that. I'm going to sell it. The stock's going to drop in price. The opposite is also true. Your t-shirt company may only be an underperform, but that's priced in, right? Remember I talked about it being $20 here? It's priced in. Your stock is $20 because that's priced in. So when an analyst comes and upgrade it, you might see a bump up to $21 or even $22. Who knows? I mean, obviously, there's a lot goes into that. But it's the direction that we care about. It's the direction that we focus on with these analyst upgrades and downgrades. All right. And again, I know they're silly. You'll see some of the goofiest things with these price targets and stuff. And you're just like, who's paying? Why? Well, this is just silly. I want to use this example of ADBE here. And then I'm going to answer some of you guys' questions after this. But this is Adobe, who released earnings 2 days ago. And this is a really great example that we can learn from, because this is just crazy earnings. All right. Now, there's a lot of other things that will go into earnings that we want to keep in mind. What's overall market sentiment? Adobe is a tech play. So this reaction, has a lot to do with tech selling off recently as well. And the markets are selling off, having the worst December in since 1980 or something crazy like that, right? So people are looking for reasons to sell stocks as it is. Okay. However, for the actual reaction of stocks, this is when the company released revenue or released earnings. Look at the reaction. It first, this little green candle here popped up a couple dollars. It then fell all the way to 232. Literally 2 minutes later, it hits 260. And then it settles out here for a little bit. I actually mentioned that I really wanted to short this in after I was at 250. I never pulled the trigger on it. And then it ends up selling off really slowly. So now let's talk about what were the actual earnings on this stock. First, I just want to talk about this initial volatility is insane. And we see this all the time with earnings. The earnings get misinterpreted, then they get oversold, then they get overbought, and then people chase and have FOMO and panic. It's nuts. You'll see some crazy, crazy things when you watch a company release earnings. Okay, we have some exciting earnings this week. Nike released earnings on Thursday, if I'm not mistaken. I'm sure we'll have a super volatile reaction just like this. Now, let's talk about what the actual earnings were. Oh, first I want to talk about after these earnings came out, look what this analyst did. Okay, they raised the price target from $295 to $300. The stock's trading at $230, right? I mean, it's $60 off the price target. You're thinking, why the heck would they even bother raising the price target $5 a share when this company is all the way down here, right? You're like, it's just kind of silly. But what you want to focus on is it actually was bullish and got moved upward $5 a share. Now, most banks did not feel that way. And most, obviously, stock traders in the overall market selling off terribly didn't feel that way, right? But this is just kind of an example. This came out right after that earnings release, okay? Meanwhile, another bank maintained the stock at overweight, meaning they didn't upgrade it or downgrade it. They just came and said, hey, we feel good about our previous buy rating on it. Okay. Now, when a company reports earnings, this is what you're going to see in your news feed. And you're going to be like, what the heck is all this? This is crazy. Right? The first one I want you to focus on is this bottom one, and it's the initial headline. Look at the initial headline. Adobe reports record quarterly and annual revenue. You see that headline? That's a very flashy headline, record quarterly and annual revenue. And that very headline, I feel basically that headline alone was responsible for this huge spike up to 260. But then what happens is people start to digest the news a little bit and see, okay, well, let's see what actually happened here. Take a look at this up top. EPS was 160 versus 188 estimate. That's a miss. It's a miss by 28 cents. That's a pretty bad miss there. Now they beat sales. They did 2.54 billion versus 2.52 billion estimated, right? This was what they actually did. This is what the estimates were that came from the company the quarter before. So they slightly beat sales, but this is a pretty bad EPS miss here. Pretty significant miss there. Okay. But look what the company does. They come out and say it was a record quarterly, an annual revenue report. And it was, they've probably never done more sales on this ever. Their EPS probably has never been this high before, or, maybe it has, but it just didn't beat estimates, right? So you might look at this and say these aren't really bad earnings, but in terms of how they were relative to what the market was expecting, the market didn't like it and they sold it really badly. We ended up shorting this stock. Actually shorted it today too. We shorted it Friday and today and made a lot of money off of Adobe, multiple times shorting that stock, and it was huge for us. Okay, next thing I want to show here is guidance. This was the guidance that the company reported. This is Adobe. They released guidance. Okay. Now take a look here. The company said The year 2019, we're expecting to do EPS of 7.75, which is lower than the estimated EPS originally, which was almost $8. Okay, so they're lowering guidance. Remember this, the stock market was expecting this company to, release guidance of almost $8 EPS, but they lowered that. So now the stock market's kind of freaking out. Oh no, they lowered their guidance. Not only did they miss EPS for this last, quarter and things like that, but they're lowering their expectations for themselves in the next quarter. That scares a lot of people. When guidance ever gets lowered from a company, that's bad news. Now they're raising sales. They think they'll do more on sales, but this means that they must have some other overhead cost issues and things that are affecting that, right? And people care about this a lot. It's really important if a company ever lowers their guidance and things like that. All right, next I want to talk about implied volatility, and by next I mean I'm going to make another video about it, and we'll talk more about it. But implied volatility, in terms of how it relates to earnings winners, is super important to understand. Okay. Just as a real quick recap of our trades today, and I'm not going to get too in depth about this, I mainly just wanted to focus on the specific earnings numbers and things. And then, next week we're going to have a follow-up webinar, and I'm going to talk about this now. How do we actually trade it? Now that we have the definitions down and things, and we can analyze it itself, now how do we actually trade it? That's what next week's webinar is going to be about. So, this is an awesome day for us. We're up almost $1,500 today. So that's going to sum up the information I have here to share.